I briefly did a little bit of work on HIMS and nothing too extravagant, right? And a lot of it's just kind of the blind eye test comparatively to what the kind of earnings report are. And they do a really good job uh, when it kind of comes to where they were over the past several quarters to where they are now, and where they continue to potentially look for. And I just did some brief estimates. And with that, you can start to kind of formulate whether or not things are rather cheap from an organizational perspective or not. And so let me just pull up a quick um, view of HIMS in terms of the price and what things are kind of looking at. And I know other people are a big proponent of this. I'm not trying to devalue any of the work that other people have done or anything of the like. It's just me kind of doing an independent of assessment. I had some people reach out to me and said, "Hey, I'm curious what your thoughts are on HIMS." And I personally have never looked at it. I've seen it quite a bit from other folks that are looking through the market trying to look for things. And I know when 2Q came out, everyone was really excited. Um, so you can see in the last 5 years or so, they're down about 33%. But year to date, up, kind of even. Past year, down 3%. The past month, down 7%. And so they've seen their peaks and troughs, I anticipate, just associated with the normal, sharing of news and everything of the like. So if any of you guys don't really know necessarily about what the company does, I'm not really too familiar with it. I see their advertisements all the time on Instagram. And I know that they've also started to expand into the female side of providing. So now they're kind of calling themselves hims and hers when it used to be hims. Maybe they've always done hims and hers, but it's just interesting that now they're kind of doubling the market, which I think is pretty cool. If they were only specifically focusing on hims before, right? Because I've only really seen it advertised as hims. So anyway, so hims and hers operates a telehealth consultation company, and they basically are healthcare professionals enabling to access medical care for mental health, sexual health, skin care, and just normal primary care. So I think it's just a different way to kind of access health. And everything that I've kind of seen on Instagram is always, generally speaking, focused towards mental health or sexual health. So I'll just be blunt. That's the advertisements I've sort of seen. I've never used the product. And I think all the advertisements say that the product works, but so does everything that you see when you see a normal product on TV or anything like that. So I'm not saying that the product doesn't work, but at the end of the day, you kind of have to take those things with a grain of salt. So hopping specifically into the investor presentation here, let me just go into here. Is it this? Yeah. So I just went specifically into the 2Q investor presentation and went through and said, what do I think here? So just looking at the stock, I did show the Robinhood chart there. At the moment, $1.35 billion company. So in that respect, relatively smallish sort of cap sort of stock. So with respect to that, is this thing actually producing any capital? I don't really know, right? So this is kind of where it gets into exploration mode for me. And my initial thoughts, I'll get into some of the numbers and maybe dive a little bit deeper, but my initial thoughts were, this doesn't seem too bad, right? And what I mean by that is you're getting to the place where, and we'll walk through it in the presentation, you're getting through the place where you're starting to get EBITDA positive. And so with that, only in a $1 billion valuation, if you're able to continue the growth that they've been able to see, which we'll get into as well, and have the long-term EBITDA margins that they're expecting from the organization, you're going to start getting to a price to EBITDA multiple that can get very small very quickly. Now, what that would then mean is if they're able to maintain that revenue growth and they're able to maintain that margin, then you could see a price of this thing kind of explode at, I guess, as quickly as they're kind of growing, right? If they're able to maintain that sort of margin. So Now that a lot of their overhead and everything is kind of taken care of, I'm anticipating, and I've done some brief calculations, and we can spread it around and kind of do some quick math and stuff of the like. But it doesn't seem too far fetched if this thing continued down the path where it should be potentially next year or 2 years from now, making about $100 million in EBITDA. um, then then it might look pretty attractive here to potentially look at. But that all is dependent on what's their total market, how much are people going to stay on. It looks like they have a decent retention rate, but that's just kind of the initial thought. It looks like it's a pretty decent opportunity to look at and at least establish a small position. Well, I probably not. There's other things I currently kind of have at the moment in my portfolio that I'm kind of holding on to that are in similar positions. Like I have Rocket Lab, I have Bros, I have Palantir that are all kind of in this position. Palantir is a little bit further ahead in terms of it's been EBITDA break even for some time. Now it's getting to the point where it's net income positive and stuff of the like. But putting that sort of stuff aside, for me, it doesn't necessarily warrant. It's not something that I wouldn't potentially say I'll never invest in, but it's just not something I'm focusing on at the moment. Maybe if I dive a little bit deeper, I'll feel a little bit better about it, or what have you. Because I feel like these things with Instagram and what have you, they come and they go. And so I'm going to look at the initial numbers, and then I'm going to pull up the actual SEC, because this was really only just providing an income statement, maybe a little bit about cash flow. But what I don't have is the full cash flow statement. I don't have the full balance sheet. And so I don't know what their obligations are in terms of future debt or anything of the like. So it always helps to kind of dive deep into those 10Qs to really understand some of the underlying poop that's in any sort of stock. And I recommend doing that with any company, because people might think that there's something weird going on with this or that. And generally speaking, there's a lot of verbiage that they either might mention in the earnings report, or they might kind of like allude to in the earnings report, but not fully discuss. Generally speaking, because if they don't disclose everything in those 10Qs, things go pretty bad pretty quick, right? So in that respect, like reading those 10Qs, if you have the time, even if you don't really understand the numbers, you might be able to understand a little bit more about the underlying value of what's going on in the organization. So anyway, I like this problem statement. They're on a mission to help the world feel great through better health. I like that. A lot of this is just sort of branding. This is a lot of the stuff that I've seen throughout um, Instagram and stuff of the like. But this is kind of where my initial want to look initially goes, right? 90% recurring revenue, 75% gross profit margin, in terms of like, I guess, the initial sort of products themselves, less than 1 year payback. There's a lot of footnotes and stuff like that. But initially what I'm seeing is year over year, 74% subscriber growth, 80%, revenue growth, 12% EBITDA margin growth. So they were -7 in terms of EBITDA margin. So they made 113 million in terms of EBITDA. A year ago, they probably lost 7 or 8 million in EBITDA last year. Here they are returning 1.3 million subscribers, 207 million for the quarter, 5% EBITDA growth. 5% EBITDA period margin. So they're walking away with, what is this, 10 million, 11 million in sort of EBITDA. And so if you kind of annualize that, knowing this is kind of recurring revenue, right? Doesn't seem like it's going to be very cyclical. You're looking at 35 to 40 million in EBITDA, right? So let's just do a quick think about that. If you're at a 1.4 billion market cap and you divide that by 40 in terms of the $40 million in EBITDA, you're looking at a price to EBITDA of 35. That's not out of control, right? Especially if you're going to continue to grow the organization at the pace at which they have been growing the organization. But the problem that I have with is I don't know where they're going to top out, right? That's the problem with any company, right? If you're able to continue this 12% EBITDA margin growth per year, that, let's just take, for example, they're able to grow that an additional 12%, or even let's just say they keep that 5%, but instead of the 800 or so $1 million in revenue they're going to make, they make 2 billion in revenue. That's $100 million in EBITDA. You go down and pretty quick to a 16 times multiple in terms of price to EBITDA. Now, I know some people don't like price to EBITDA, but the problem that you kind of see with EBITDA, it kind of just rules out a lot of the initial kind of thoughts with like share-based compensation and one-off tax items and stuff of the like. And I know the EBITDA, that's before interest and taxes, depreciation. But EBITDA to me is kind of just like you know, if you were to strip everything dry, very little debt or anything of the like, how are you showing up from a business profitability standpoint? Is what you're selling profitable? And in this particular case, you're seeing you're getting a 5% margin that could probably grow. I think later in the presentation, they show it can grow probably closer to 20% to 30% in the long term. I don't know what long term means. I don't know if that means in 5 years, 10 years. But for me, I'm just going to assume eventually you get to that 20% multiple. So keep, or not 20% multiple, 20%, so kind of keep that in the back of my mind. And let's just say you are able to get to 2 billion, then, or 3 billion, then you're starting to get to the point where you're making, $400 million a year in EBITDA or $500 million a year in EBITDA. And so then you're talking about 1.3, $1.4 billion stock. It gets really cheap pretty quick, but that all requires a lot of growth and revenue, and who knows where you actually end up. So this is a slide that I thought was pretty cool. What I don't understand specifically is, how much potential volume and stuff gets to here, right? So just because there's an estimated population doesn't mean they're going to be able to access all that, right? So this is the kind of markets that they have entered to date. So continue to unlock immediate markets, future unpenetrated opportunities. You can see there's testosterone, prostate, menopause, digestion. But where they have is ED, erectile dysfunction. I think PE is premature ejaculation. For women, they have birth control, STDs, libido, dermatology, they have hair loss, acne, aging. And so all these things, generally speaking, pretty consistent across the market. There's a lot of different places that you can get it. You might be going to this particular company for this formula. You might be going to this company for a different formula. So if you're able to get a subscription-based model, get everything from one company, I can kind of understand it. Other markets that they might look at, this is a big one, considering like all the GLP-1s that like Chris always talks about. This is weight, pain management, fertility, diabetes. All of this has kind of like 100 million population sort of growth, or not population growth, this population that they can access. So interesting from that standpoint, right? And they have other opportunities that they'll look at: eczema, rosacea, PTSD, insomnia. So other things that they will try to introduce as well. And so looking specifically here, see some people that have a lot of experience: Braintree, Google, Zulily, Bonobos, Google again, Jones Day, Hartford Healthcare, Dartmouth, Walgreens. I don't know what Atomic is, but Atomic. And so decent kind of people in terms of who's in the executive team. And you have a bunch of affiliations and stuff like that. So this seems like a pretty interesting sort of organization. And so far, you can't really scoff at it. I think the thing, it goes into a bunch of like the culture, technology, all that stuff. I think at the end of the day, the thing that really I try to understand is where this thing can get from a valuation perspective. I know a lot of people care about, the hype. Is it going to be a 10x stock? I can't say that just by looking at this, right? And I'm not very good at being able to project long-term run rates or anything of the like in terms of where I think that the total addressable market for this could go. I don't know. I don't have that sort of experience. I'm not really a biotech guy. I don't really look at that particularly, but it seems like this is something that's working. right? So, I mean, if you're thinking about it from that perspective, it doesn't seem like it's a scam, right? And I see things all over the Instagram about it. I have yet to hear that it's a scam, right? I've only heard kind of things, rumblings that it works. So, what do you kind of think about it, right? When you kind of look at where is this thing kind of headed, and this is what I was kind of talking about specifically. They have a lot of good data around where they were versus where they have or are today, and where they potentially might continue to go. And you can kind of start to run some numbers on that to understand, hey, you know, is this appropriately valued today? Is it overvalued? And do you think in, say, a year or two, it's going to be cheaply valued? And I would say at $6.52 as it closed today at a 1.3, $1.4 billion market cap, is it a little bit overvalued? If there was no more revenue growth and there was no more EBITDA price multiple, or sorry, more EBITDA margin increase or anything like that, you could say yeah. But the thing is that I think it's growing so quickly. Like, for example, it went from 748,000 subscribers to 1.3 million subscribers in the matter of a year's time. Even if you were to increase this another 20% or 10%, and your revenues were able to go from the 114 million that they saw per quarter last year to the 208, even if they were to increase another 30% or something like that in the next year, going to 268 from where it is today, you know, you could start to understand that this thing can get pretty cheap pretty quick. And what I mean by that is, let's just whip out a calculator. I don't know if you guys can see the calculator. You can't see the calculator. I don't know how I can share the calculator with you guys as well. Let me see. Entire screen. Well, that doesn't really help. But maybe a little streamception here really quick. So you guys can see the inner workings here. But let me know if you guys can see all that. Yeah, you guys can see all that. Cool. So ignore the 74% year-over-year revenue growth, the 83% year-over-year, revenue growth, 74% subscriber growth. Let's just take, for example, let's just say you get to 300 million in EBITDA per quarter, which gets you to 1.2 billion in annual revenue, right? And you'll see what it looks like here with where it is today, which I think they're estimating about 40 million in EBITDA and stuff like that. Let's just say they're only going to keep it at 0.05 million. So you're at 60 million in terms of EBITDA, 0.05% or 5% EBITDA margin. You're at 60 million in EBITDA, right? So you're at 1350 in terms of the market cap. Divide that by 60, you get to 22.5 times price to EBITDA multiple. Now, let's just say, for example, you're now not just getting to 200, but let's just say you double things, not in next year or anything like that. Let's just say you double things from where they are today. They're on a pretty good trajectory. Let's just say by chance they do double and they're at 400 per quarter. Multiply that by 4. You're at $1.6 billion in revenue a year, 5% EBITDA margin. So you're at 80. You're at 1350 divided by 80. Okay. You're at a 16x sort of multiple price to EBITDA. Granted, you do have share-based compensation, you have some stuff like that. But overall, it's not awful. And I'm assuming you guys can still, when I'm sharing this, you guys can see the calculator and stuff, right? So if you can't, you kind of got to let me know. But I'm anticipating that you can see the calculator, and then I'll probably pause a little bit for some questions. But let's just say, for example, let's say you get 2 or 3 years of an additional 25%, 30% revenue growth. So you're at 208. Let's just say you get an additional 1.25 for say 2 more years, maybe 3 more years to make it 400. That gets you to the 16x multiple. Let's just say you go for 25 times the next 25% for the next 20 years, or sorry, 5 years. I'm mixing up all my numbers. 25% for the next 5 years, you get to 500. That's 2 billion in revenue. At 5% multiple, you get to 100 million, right? So 1.35 billion in market cap. Divide that by 100 million, you get the 13 and a half multiple. But recognize that they also, somewhere within here, they stated how they wanted to get closer to an EBITDA margin. I think it was in the 20 to 30% range. And their trajectory for 2025 is 1.2 billion. So let's just say they do in 2025 get to their 100 million, right? The stock is 1.35 today. Divide that by 100 million, you get to the 13 and a half multiple. I think that's pretty damn good. But right, let's just think, for example, they are able to get to 1.6 billion in revenue, and they're able to get to the 0.2, say, EBITDA margin. That's 320 million in EBITDA, right? If that's possible, right? I'm not saying it is, but think about it. If let's just say you get to 1.6, you get to the 0.2 terms of EBITDA margin, they maximize their efficiencies, everything's up and running very good. $320 million a year. So they're at a 1.35 divided by 0.32. The price to multiple at that point is just absurd. So in order for that to make sense, right, let's just say a 0.32, they get to that point. So keep in mind, this is probably 10 years down the road or something like that. For it to kind of make even a little bit of sense, it might be a $4 billion, $5 billion company. The problem is with all this, per se, is you also have to take into account that there is a little bit of that share-based compensation dilution going on as well. And this is the same thing in Palantir and some of these other things. So this isn't specifically just HIMS or anything like that. So let's just kind of look into some of these numbers, these real numbers here. So Q3, so next quarter, they're hoping to get to 220 basically in revenue, and 830 in terms of fiscal year 23, and 35 to 40 million in EBITDA. We were kind of right on that. So can't complain with that. They're hoping to maintain 85% margins. And I'm trying to think where else they kind of showed. You can see the large growth in revenue over the past 2 or 3 years, the large change in adjusted EBITDA. But you can also see the stock-based compensation, right? Anywhere between $8 to $16 million a quarter. And so that eats into it as well, right? It's no different than Palantir at that point. So that's where you're seeing this net loss number kind of come in, right? Because you do have depreciation, you have other things kind of going on that impacts this specifically. But you are getting to a point where EBITDA is kind of break even. And really the only thing that is deterring you away from that to getting your net loss is the stock-based compensation. So you subtract the 16.8 from this 10.6, you get close to that 7.2 loss in terms of where they kind of were. And so you're getting close to break even in that respect as well. So I think if you wanted to be a little bit more conservative, maybe you'd utilize this net income rather than the price to EBITDA. But I think that that's a good place to start. I mean, if you truly think that the company can get to $2 or so billion worth of revenue, I don't think it's a bad place to kind of park some money. But to me, I just don't understand the long-term trajectory of the organization enough where I would truly be really happy investing money in that. A Palantir, a Rocket Lab, I can understand to an extent where those revenue streams are going to end up. With HIMS, to me, I'm like, I just see everything on Instagram. I see everything on Facebook. I'm like, to me, that gives me an underlying fear that it requires a lot of marketing in order to get it. And I'm like, I don't know if that marketing is just to establish a base and then the base is going to be very continuous, or if that's something where that's not going to go away and they're going to have to continue to market very aggressively. And in that respect, the EBITDA margin is not going to get to the 20 to 30% like they think it is. So it, I'm not saying it's a bad opportunity. I don't think you'll lose a ton of money at the $1.3 billion market cap valuation. But what I can't say is, are you going to 15 or 20x your money? Do I think you could potentially keep up with the S&P? Yeah, potentially. I would need somebody to educate me in where they think in the long term the company is headed from a revenue growth perspective and how long that trajectory is. So I've spent about 30 minutes walking through it, giving you some thoughts, telling you my uncertainties, telling you the things that I do like about the organization. I will sit around now and probably just see if you guys have any questions, comments, concerns.